There is a moment every serious trader experiences but almost never talks about, and it happens before a single profitable trade is made. It is not a news headline, it is not a chart pattern you learn from a YouTube video, and it is not some magical alignment of indicators that suddenly makes everything click. It is a quiet internal shift, a convergence of conditions that tells you the environment has changed in your favor, and if you miss it, you will keep grinding against the market instead of moving with it. Most retail traders spend years looking for setups when they should be looking for states. A setup is a trigger. A state is a condition. The base hit strategy is not about swinging for home runs on every trade. It is about recognizing when the field is tilted in your direction and consistently putting the ball in play until the scoreboard changes in ways you planned for weeks in advance. The first hidden sign is when your losses start feeling boring instead of painful. That might sound like an odd thing to celebrate, but experienced traders know this transition is significant. When a losing trade stops triggering an emotional reaction and starts feeling like a predictable cost of doing business, your psychology has crossed a threshold that most people never reach. Before this shift happens, losses feel like personal failures. They create an urgency to recover, which causes overtrading, position sizing errors, and revenge entries that compound the damage. After this shift, a loss is just a line item on a balance sheet. You close it, record it, and move to the next setup without any emotional residue carrying forward into the next decision. This psychological change does not happen by reading about discipline. It happens through repetition, combined with a rule set you actually trust. When your rules are vague, losses feel random, and random losses are psychologically destabilizing because your brain cannot categorize them as expected outcomes. Specific rules produce expected outcomes, and expected outcomes, even when they are losses, register as confirmation that the system is working. The second hidden sign is when you stop checking your positions every few minutes. Hypervigilance in trading is a symptom of a deeper problem, which is that you do not fully trust the edge you are supposed to be executing. When traders refresh their charts constantly, they are not managing risk, they are managing anxiety. Those are completely different activities with completely different effects on your equity curve. Position monitoring has a legitimate purpose inside a defined structure. You check at key levels. You check when news catalysts are scheduled. You check when your setup parameters require a decision. Everything outside of that is emotional noise dressed up as due diligence. The moment you catch yourself stepping away from your screen without the pull to come back every 90 seconds, something real has changed in how you relate to uncertainty. That change matters because the market does not reward constant attention. It rewards correct decisions made at correct times. A trader who makes 3 high-quality decisions per day at predetermined decision points will outperform a trader who makes 30 reactive decisions because they cannot tolerate the discomfort of not knowing what is happening right now. Compulsive monitoring is a leak in your mental capital that eventually becomes a leak in your financial capital. The third hidden sign is when you begin noticing liquidity before you notice direction. This is a subtle but powerful cognitive upgrade that separates traders who consistently extract money from the market from those who keep donating it. Most retail traders enter a chart and immediately ask themselves, which way is this going? Experienced traders enter a chart and ask themselves, where are the orders clustered and what needs to happen before price can move cleanly? Liquidity is the fuel that moves markets. Large institutional orders cannot be filled in thin areas, so price is consistently engineered to move toward areas where resting orders are concentrated, trigger those orders to fill institutional positions, and then reverse in the intended direction. When you start reading this mechanic naturally, your entries change completely. You stop buying breakouts and start buying the pullback after the liquidity grab that preceded the real move. This shift shows up concretely in your trade review data. You will notice your entries start landing closer to actual turning points instead of somewhere in the middle of a move where you felt confident enough to enter. The reduction in your average entry slippage relative to the eventual target is measurable, and it is one of the clearest indicators that your market reading ability has leveled up in a way that will compound over time. The fourth hidden sign is when your watch list shrinks voluntarily. Early traders want more. More setups, more tickers, more opportunities, more screens. They believe that trading more instruments means more chances to profit, and that belief is understandable because in almost every other profession, more activity produces more output. Trading punishes that logic aggressively and consistently. When you voluntarily narrow your watch list down to a handful of instruments you understand deeply, you are not limiting your opportunity. You are concentrating your edge. Every instrument has behavioral tendencies, specific ways it reacts to volume, specific ways it behaves around key levels, specific relationships between between price action and the broader market context it operates within. Knowing those tendencies deeply is worth more than shallow familiarity with 50 different tickers. The traders who shrink their watch lists do it because they have experienced the difference between a trade taken on a familiar instrument and a trade taken on something they only partially understand. The familiar instrument trade feels different. The read feels cleaner. The entry and exit decisions feel more calibrated. That qualitative difference is real, it is not imagination, and it shows up as better execution statistics when you run your monthly performance review. The fifth hidden sign is when you start planning your exits before your entries. This is one of the most counterintuitive transitions in trader development because the entry is what feels exciting. The entry is the moment of commitment, the moment where you convert analysis into action. But the exit is where the money actually gets made or lost. And traders who plan exits first are operating in a fundamentally different and more profitable mental framework. Planning exits first forces you to define your reward before you define your risk. When you look at a chart and first identify where price would have to go to prove your thesis right, then identify what invalidates the trade, and only then calculate whether the distance between those 2 points justifies the position size you are considering, you are trading from a position of clarity instead of hope. Hope is the most expensive emotion in trading. Exit first thinking also solves one of the most common execution failures among developing traders, which is the inability to take profits at predetermined levels. When a trade moves in your favor and you have not pre-committed to an exit, greed begins negotiating with your original plan. You start thinking about how far it could go instead of executing the plan you had when your thinking was objective. Pre-planned exits remove the negotiation entirely because the decision was already made under conditions of clear thinking. Now that the 5 signs have been laid out, the real question is how to use this framework as a diagnostic tool rather than a checklist you rush to complete. Each of these signs represents a layer of trader development, and they do not all arrive at the same time. Some traders develop the psychological detachment from losses early, but never fully develop the liquidity reading skill. Others narrow their watch list instinctively, but still struggle with exit discipline. Your particular configuration of developed and undeveloped signs tells you exactly where your next unit of improvement should be directed. The base hit strategy works because it aligns your activity with your actual edge. When you are in the zone as a trader, you are not making bigger bets or taking more trades. You are making cleaner decisions on higher probability setups with greater consistency. The accumulation of those clean decisions at favorable risk to reward ratios is what produces equity curves that look like stairs instead of roller coasters. There is a concept in performance psychology called flow state, and most people associate it with athletes or musicians. But traders enter flow states too, and the characteristics are the same. Time perception changes, decisions feel automatic rather than effortful, and the gap between intention and execution narrows almost to zero. The 5 signs described here are not a flow state itself. They are the preconditions that make flow states accessible on a regular basis rather than as rare accidents. One of the most damaging myths in trading education is the idea that more knowledge produces more profit in a linear relationship. It does not. There is a point where adding more information, more indicators, more strategies, more market hours, and more screen time actively reduces your performance because it fragments your focus and dilutes your edge. The zone is not a place of maximum information processing. It is a place of precise information filtering. The traders who remain in the zone consistently have built what amounts to a perceptual filter that runs in the background at all times. When they look at a chart, irrelevant information does not even register consciously. Their eye moves immediately to the features that matter for the specific approach they are executing. Building that filter takes time, but it is accelerated significantly by deliberate review practices that reinforce which signals led to successful outcomes and which signals were noise. Your trade journal is the single most underutilized tool in retail trading, not because traders do not keep journals, but because most traders keep descriptive journals instead of analytical ones. Describing what happened in a trade is the starting point. Analyzing what your decision process was at each step, what information you prioritized, what you felt physically and emotionally during the trade, and how the actual outcome related to your expectations is where the developmental work happens. When you approach your journal analytically, patterns emerge that are not visible in your raw performance statistics. You might discover that your best trades are systematically taken in the first hour of a session, and your worst trades cluster in the middle of the day, when volume thins and price action becomes choppy and random. That single insight, which only surfaces through careful journal analysis, could improve improve your annual performance by changing nothing except the hours you trade. The concept of the base hit in baseball is instructive for another reason beyond its obvious metaphor. A base hit advances the runner without requiring a perfect swing on a perfect pitch. It works with available conditions rather than waiting for ideal conditions. Traders who wait for the perfect setup before engaging with the market are essentially waiting for a pitch that arrives less often than they think. And while they wait, they are losing the practice repetitions that compound into real skill over time. Base hit trading means you have defined a category of setup that is good enough, meaning it has a positive expectancy, manageable risk, and a high enough occurrence rate to generate meaningful sample sizes within a given period. You execute that setup consistently, you let the law of large numbers work in your favor, and you resist the temptation to abandon the approach during the inevitable losing streaks that are part of any valid statistical edge. The losing streaks deserve a specific mention because they are where most traders abandon valid strategies prematurely. A losing streak does not tell you that your strategy is broken. It tells you that you are in the normal distribution of outcomes that any strategy with less than 100% win rate will experience. The question is not whether you will have losing streaks, but whether you can distinguish between a strategy that is statistically underperforming temporarily and one that has genuinely stopped working in the current market regime. That distinction requires data. Specifically, it requires enough trade history to establish baseline performance metrics so that you can identify when current performance represents a meaningful deviation from your historical norm versus when it falls within the expected variance. Traders who abandon strategies after 10 losing trades rarely know whether 10 consecutive losses is statistically likely or statistically anomalous for that strategy, because they never ran the numbers when their thinking was objective. Running those numbers during a profitable period when your emotions are not under pressure is one of the highest value activities you can engage in between trading sessions. Calculate your maximum historical drawdown. Calculate your longest historical losing streak. Calculate your average losing trade duration and your average winning trade duration. Build these benchmarks into your trading plan so that when adversity arrives, you have pre-established criteria for distinguishing normal variance from actual edge deterioration. The market environment also plays a role in when the zone is accessible and when it is not. Every strategy has a market condition it was designed for and market conditions where it underperforms structurally. A trend-following approach will underperform in choppy, range-bound markets regardless of how well you execute it. A mean reversion approach will underperform in strongly trending markets for the same reason. Part of recognizing when you are entering the zone is recognizing when the market is in a state that your specific approach is calibrated to exploit. Market regime identification is a skill in itself, and it is built through screen time combined with retrospective analysis. Looking back at historical charts and labeling periods by regime type, trending, ranging, volatile, low volatility, trains your eye to recognize current conditions faster and with greater accuracy. This does not eliminate misidentification entirely, but it reduces the frequency with which you are executing a trend strategy in a ranging market and wondering why your results do not match your backtests. The traders who stay in the zone long enough to compound serious wealth have one characteristic above all others that separates them from those who experience the zone briefly and then lose it. They treat trading as a performance discipline rather than a financial activity. The financial results are the output, but the inputs are all performance-based: preparation quality, decision quality, execution quality, review quality, and the daily management of the physical and mental conditions that allow high-quality performance to occur. Sleep, nutrition, exercise, and stress management are not soft productivity topics tangentially related to trading. They are direct determinants of prefrontal cortex function, which is the part of your brain responsible for risk assessment, impulse control, and the ability to hold a rule in mind while resisting contradictory impulses. When that function is impaired by poor sleep or chronic stress, you will break your trading rules not because you lack discipline, but because your brain is literally operating with reduced capacity to enforce them. The 5 hidden signs of entering the zone as a trader are simultaneously signs of a mature trading psychology, a refined edge, and a sustainable operating system. When losses feel like expected costs, when you stop compulsively monitoring positions, when liquidity catches your eye before direction, when your watch list shrinks voluntarily, and when you plan exits before entries, you are not just having a good week. You are demonstrating that the internal architecture required for consistent performance has been built and is functioning as designed. The base hit strategy succeeds because it is honest about what the market actually offers. It does not promise spectacular returns on every trade. It promises a repeatable process process that accumulates edge over time through disciplined repetition. The traders who build real wealth in this business are almost never the ones making the most dramatic individual trades. They are the ones who figured out how to show up at their best, day after day, week after week, executing a defined approach with the consistency of a professional and the patience of someone who understands that in trading, the most valuable asset you possess is not capital. It is the compound interest on every correct decision you make when the conditions are right and you are ready to execute.